Welcome to First Mover, your first global look at today's action in Bitcoin, blockchain, and digital assets. I'm Michael Casey, filling in this week for Christine Lee. Joining me are my co-hosts, Managing Editor of Global Capital Markets, Lawrence Lewitton, and Emily Parker, Managing Director of International Content. Good morning, Lawrence and Emily.
Hey, good morning. How are you?
Very well. A dump of snow out there, though, like just really a lot of it looking out the window. I'm looking forward to getting the snowblower at some point, and if I can find the time to get out there and clean this thing up. But
that's what children are for.
That's right. Although, not as easy in a household like mine at this stage. Markets. I know that we just talk about it all week, but it just really looks kind of ugly out there. Bright red across the crypto world. Not a happy picture. What are your thoughts about all this, Lawrence? I know we had the jobs report out as well, right?
Yeah, the jobs report came out, and the growth in jobs was kind of like it was disappointing. It was like 199,000 or something. It wasn't anything to crow about in terms of growth. So I don't quite yet know, and I don't think we know yet what that means for the idea of a tapering and how it would look in this market when you had that kind of a lackluster growth. But we have to remember a few things. These are because of variables such as the Omicron variant, which might go away in the next few weeks, as far as we know, based on what's going on in South Africa. So these could be slight blips in the data, and it's not anything I would say you can forecast long term here. And so we look at the markets right now. Whatever negative we're in probably has to do with other things than just the global macro economy. Though you and I disagree a lot about that.
But either way, if you're a policymaker in this environment, it's extremely difficult, right? These are very unpredictable and just very hard to predict times. Emily, what are you looking at?
Well, I think there's a news story that GameStop is getting into the cryptocurrency and NFT space. GameStop, as we all know, is famous for its meme stock and Reddit performance. And this sort of seems like the perfect convergence of narratives, because now GameStop is looking to basically start selling and trading NFTs of video game avatars as part of a turnaround plan. So it just seems like a kind of a perfect compilation of stories.
It's perfect. It is the full circle story. Glad we had the blockchain DAO guy on earlier in the week to talk a little bit about some of these meme concepts. But it's all good stuff. So let's take a look at crypto markets now. I got to tell you, folks, it's not a pretty picture. It's not our fault, but it's not great. Bitcoin is at 41,450. That is the CoinDesk Bitcoin Price Index XBX. It is down 3.79% on the day. The CoinDesk Ether Price Index, ETX, is at 3,162. That's down even more, 7% on the day. And the DeFi CoinDesk DFX Index is at 431.59, and that's off by 2% on the day. So our next guest is going to talk about the year of Ethereum, which is a lot of people talking about for 2022. It's basically, this is what Paul Brody, a global innovation leader at Ernst is arguing. He makes his case in an opinion piece that was published on CoinDesk.com, and he's here now to explain why he takes this position. Good morning, Paul.
Good morning, Michael. Good morning, everybody. Nice to see you.
Good to see you, and thank you for you've been quite prolific lately with your contributions to CoinDesk, so keep it up. It's all good. Look, I read your piece, and I thought, is Paul just looking to get into a fight with Bitcoin maxis? Because you start out like identifying that there's this meme-induced fog of propaganda between Bitcoin maximalists and Ethereum boosters. You're talking about this fight in some respect that's just been going on for ages. And then the first thing you do is come out and say, first and foremost, 2022 is all about Ethereum. So clearly, you're looking to pick a fight maybe, but where do you stand on this, the fact that there is this, people who are dismissing, Jack Dorsey being one of the most prominent of them, the Web3 Ethereum thing as all being about fluff. What's your answer to them?
So my answer is I'm not an Ethereum maximalist. I am, to coin a term, I'm an Ethereum practicalist. And what I mean by that is that I look at the history of technology and I think a lot about sort of what happens when a digital ecosystem reaches escape velocity. And the answer is it becomes dominant not because it's the best, not because it has the most brilliant people, but because it is widely used, right? And the analogy I often make is, if I was going to write a PC application, I wouldn't say what's the best PC operating system. I would say who's got the most users. And the answer is the Ethereum ecosystem has the most users, it has the most capital, it has the most software developers. And that means that it's going to become the dominant ecosystem, not because it's the best, because the best technology never wins, but just because for practical purposes, that's where you want to build your business.
Hey, Paul, I like your unicorn t-shirt, first of all. Everything you said about Ether, points well taken, but there's also, Ethereum has one big vulnerability, which is high gas fees, right? And this has been a consistent problem. And, with the upgrade of last year, it made gas fees a little bit more predictable, but didn't actually lower them. And I know this is something that people are hoping for with ETH 2.0, but this is what's kind of opened up the market to these so-called ETH killers. What is your take on ETH gas fees, and when do you see that problem finally getting more under control?
So that problem was solved 6 months ago. And this is where the conventional wisdom is out of sync with the reality. And we'll catch up relatively quickly. So 6 to 9 months ago, we were spending $30, $40, $50 to execute every single transaction. Today, we spend about 2 cents or less, right? We gave out New Year NFTs to 8,000 people. And it cost us like $100. So the answer is, when you move to layer 2 on Polygon, right, you have all the benefits of the Ethereum ecosystem with very reliable gas fees. And so the layer 2 kind of transition is been, in the end, much more important than this mythical kind of ETH 2.0. So ETH 2.0 is coming, but what people are missing is that Ethereum is demonstrating all the kind of maturity we want from an industrial scale ecosystem. They do hard forks every 3 months. They've got super boring technical committees that sound a lot like the IETF, right? Ethereum is behaving like a mature technology infrastructure that's going to scale nicely. And the gas fee problem is actually over, in my opinion.
So I'd push back on that a little bit, just because, I was playing around on OpenSea recently and trying to make an NFT, and ETH gas fees were still in the hundreds of dollars, which, just for experimenting with an NFT, that's a pretty high barrier to entry, right? So I guess, I wouldn't say that they're over. I think it's still an issue. And again, what Solana kind of boasts that, it doesn't have that same problem. How do you see this sort of ETH and Solana rivalry playing out this year?
So I see all of these other chains as kind of not yet prepared to acknowledge the fact that Ethereum won. And if you're paying hundreds of dollars in gas fees, it's because you're not able to access that NFT on a layer 2 system like Polygon. So what those high gas fees are going to do, and Vitalik was very clear about this, the future of Ethereum is as a chain that other blockchains use to integrate. So our multi-chain future is an Ethereum future with sort of EVM-compatible layer 2s transacting with each other. And if you want low gas fees, whether it's for an NFT or a DeFi transaction, you're going to do it in layer 2. The layer 2 transition is not complete, right? And it still frustrates me when I try to go and do stuff and I find that I can't do it on layer 2. I agree with you. If it's on layer 1, the gas fees are too high for anything other than a blockchain or a large institution.
So, Paul, you really are hardcore about it, because you say that, look, the likes of Cosmos making a multi-chain world of interoperability is not going to happen, or at least that's what it seems is what you're saying, right? You're saying that this is sort of a fool's errand, So is that really how you're going to see? You see these projects ultimately failing?
I do, and this sounds harsh, but it's what we've learned from the history of technology. So go back 20 years. I'm really dating myself, but in the early days of the internet, we had TCP/IP, right? The sort of internet control mechanism that was used to connect up all these heterogeneous different these different networks, right? There was all kinds. I can remember getting a token ring network adapter like the size of my fist once for a laptop I had, right? Those are things that we used to have. Now it's all Ethernet on IP, and it's just IP networks being connected to IP networks. I need somebody to tell me why a blockchain technology ecosystem is going to somehow mature in a very different way than almost all other networking infrastructures. And again, I'm drawing upon analogies from history here, not trying to be like an ETH is best. I'm just trying to be like, hey, this is where I think this is going to go based on how things have played out in other industries and technology stacks.
You know, you're wearing a unicorn t-shirt. My daughter's favorite things, unicorns and zombies. And you talk about zombies in layer one, ultimately, that it will need to convert to layer two. So which platform is going to do that? And which one's just going to go nowhere?
So there are already lots of blockchain platforms that have tons of money and are busy rebranding themselves. We're seeing this in enterprise clients. We'll get 3/4 of the way through a deal, and it'll be to help a client build something on Ethereum. And then some other blockchain will come around and say, hey, listen, we will pay all the money to implement this project if you do it on our blockchain. And you know, it's hard for enterprises to turn down that kind of money. We're going to see big money being thrown at these types of opportunities. But at the end of the day, you know, Ethereum does more that ecosystem, whether it's Ethereum or the layer 2 like Polygon, it's doing more transactions in a day than many of these systems are doing in a year. And if you want to sell product to a large ecosystem of buyers, you're going to pick strategically. And so I see that kind of playing out in that direction.
You know, Paul, one of the things I think is kind of cool about all this is that, you know, it is a bet on the permissionless future. It is this idea that blockchains are going to go the way of something that we all, at least in this space, tend to want to look for, where there is literally nobody in charge. And you and I have discussed this in the past. You know, you're a bit of an anomaly in the consulting world because, you know, EY is truly going from this permissionless model, whereas for some time there, a lot of the consulting firms were really pushing permissioned solutions for companies, that they would build these consortia and they'd get together. And the enterprise blockchain story really didn't get very far on that basis. But are companies, the kind of clients that EY has, at this stage, ready to take the leap into something as unpredictable as a permissionless system like Ethereum?
So your question is perfectly timed because the answer is yes. And it's very interesting. So every year in January, I poll all of the EY global partners who are willing to sort of take the time to answer me. And I ask them where they think they're seeing blockchain in terms of their clients. And I would share with you two preliminary observations from the data that's come back so far this year. First of all, the level of client interest in blockchain and sort of the level of clients saying they're more interested in blockchain is at its highest ever, right? And I've been doing this poll every year for 5 years. Secondly, the percentage of clients who say that they believe that the future is on a public blockchain is at its highest ever. It's the vast majority. Now, they fall into two camps. There's one camp that's like, hey, public blockchains are here and I'm ready for it. And there's another camp that says public blockchains are here and I'm not ready for it. But together, those two camps, which understand that the futures in public blockchains represent now the majority of our expected answers from enterprise clients. So people understand, like, the market's there, the money's there. If I want to participate, that's where I need to go.
Oh, let's see how it all goes. Good to hear. All right. Thank you, Paul. That was Paul Brody of EY. You're most welcome. Coming up, checking the markets with IDX Digital Assets.
Hi, I'm Christine Lee.
Zach Seward.
I'm Michael Casey.
I'm Christy Harkin.
I'm Isaiah Jackson.
I'm Serena Lynn.
Hey, this is Will Foxley.
I'm Teresa Santos.
Hi, I'm Lawrence Lewitton.
Hi, I'm Dorian Wayne.
I'm Nicholas Day.
Hi, I'm Kevin Worth.
My name is Naomi Brockwell.
I'm Jordan Muthra.
Hi, I'm Galen Moore.
Hi, I'm Brad Count.
I'm Pete Paschal.
Hi, I'm Jen Sanasi.
You're watching.
And you are watching.
And you're watching CoinDesk TV.
The Crypto Markets Update is brought to you by KuCoin, the best place to find the next crypto gem.
Checking in on Bitcoin again, the CoinDesk Bitcoin Price Index, XPX, is at 41,680. That's down 3.16% on the day. The CoinDesk Ether Price Index, the ETX, is at 3,195 and, 96 and 22 cents, down 5.85. And the DeFi index, the CoinDesk DFX, is at 431.75. That's down around 2% on the day. Okay, so we are now going to have a chat with Ben McMillan, the CEO of IDX Digital Assets. He joins us now to really discuss these rather ugly crypto markets. Good to see you. Hi, Ben.
Hi there.
Tell us what's going on. What is the reason for this sell-off we've seen this past week or so? And it's really an extension from sort of weakness in December as well. And please, when's it all going to end?
Yeah, no, it's the $1 million question. I mean, I think I want to hit a point that you just mentioned, which is, this is really an extension of weakness that we saw in Q4. And, even us internally, our models started raising cash back in November. And, we went fully to cash a few weeks ago. So it's not like this came out of the blue. I think what was a surprise to candidly all of Wall Street was kind of the hawkish pivot in the Fed minutes. And so that was the obvious catalyst to just, kind of precipitate a sell-off across all risk markets, which includes now Bitcoin. If you look at digital assets, cryptocurrencies, they traded down kind of in line with very high multiple tech stocks, consistent with a lot of the kind of future promise of cryptocurrencies being, priced further out. So any forward, any expectation of higher interest rates, increases that discount rate. So to your question about, what does it look like going forward? Our models are actually getting a little bit closer to putting risk back on the table. This sell-off, I think it's important to remember in the context of cryptocurrencies, this sell-off was kind of global in nature. If anything, I think this speaks to the fact that digital assets have now kind of arrived. They're trading more like traditional assets. One of the big themes we saw last year, which really started back in 2020, was kind of the mainstream adoption of institutional investors. These are the clients that we talk to. These are pensions. These are endowments. These are folks that, really weren't considering digital assets as part of a core portfolio a couple of years ago. And now all of a sudden in 2021, in part because of inflation concerns, they're figuring out ways to put it in a 60-40 portfolio or whatever that might look like. And what that means is now, interest rates and Fed policy matter a lot more to digital assets than they did a couple of years ago. So, I mean, you mentioned Ben. The Fed.
Oh, sorry.
It's okay. All right. Just pick up a little bit on what Ben was saying on the Fed. We had the jobs report out this morning, Ben. It was look on the year. This is I think the biggest gain for a very long time. Record annual gain according to the Wall Street Journal. What does that tell us about the outlook for the Fed, and therefore, that factor in the willingness of institutions and others to get back into crypto at this stage?
So that's a key question, is the jobs report. And I think what's important to remember is, how is the Fed going to view that? All eyes are on the Fed now. We got these this more hawkish expectations of, not just, rates rising a little bit sooner than expected, but also them potentially tapering the balance sheet more and sooner than expected. So I think investors are now looking at how everything is going to potentially alter Fed policy. That includes, jobs reports, that includes Omicron, and, how that might potentially just fade into the distance, or is there a new virus, on the horizon that could potentially catalyze, more monetary and fiscal stimulus? But it's really all about all eyes on Fed policy. Now, it looks like a lot of the negative expectations or surprise has been baked in. When we just look from a technical standpoint, it looks, when you start looking at order books and things like that for digital assets, there's a lot of buying power at kind of the 40,000 mark. 3,000 for ETH. So, I think there's a lot of dry powder with institutions on the sidelines kind of, looking ahead and let's not forget too, the structural bull case for digital assets is as strong as it's ever been. And, it's better than a lot of other asset classes that institutions are looking at. So the volatility has to be front and center, but the long-term outlook is still, very good.
Ben, I want to touch a little bit on the topic that you brought up earlier, this idea that crypto is becoming more mainstream and more institutional adoption of it, because we had a series of liquidations over the past few days. We've gone in Bitcoin in terms of perpetual futures. We've gone from about 19 billion to 16 billion, 10 down to 9 billion. So it doesn't seem like much, right? In the traditional financial markets, that's generally not a lot, but in crypto, it's an incredible amount of liquidations for it, and yet there's still all this leverage, relatively speaking. Do you think that's a sign that it's a mature market finally coming to, and that we might see even more leverage going forward? Or is it a worry that, hey, you know what, there's still some room for this more liquidations to happen in the coming weeks?
Yeah, it's interesting. Leverage is always a concern, and particularly, when you look at the Asia session, if we go back to summer of last year when China banned, Bitcoin mining, again, that kind of catalyzed the sell-off. But then what you saw was overnight during the Asia sessions, the massive leverage, which is much more popular among Asian traders than it is among, US or Western traders, just kind of precipitated this kind of liquidity cascade. And so, we saw a little bit after the Fed meetings. A lot of the US based institutions are not using leverage to buy Bitcoin. I think that's still much more of kind of a retail and specifically an Asian retail trading mentality. It is a concern. I mean, it's not nearly as bad as it was at certain points last year, where the kind of the leverage numbers were flashing red. But, it's something to look at, again, in the context of when you've got an exogenous event like, kind of surprising Fed minutes, to the extent that there's leverage in a sell-off, it just, reinforces any down moves. But yeah, to answer your question, about institutions, I think, really it's just the, and I like to point to, Paul Tudor Jones's letter to investors in, I think, May of 2020, where he first started seriously talking about Bitcoin as a store of value in light of unprecedented global and monetary stimulus. I think that was really kind of what popped it up on the radar of institutional investors. And, we've continued to just see, increasing adoption, flows into, Bitcoin ETFs and mutual funds. We launched a mutual fund last quarter. We're continuing to see, institutions and, not just big pensions and endowments, but wealth advisors, people that are investing on behalf of others kind of start allocating to this asset class.
Good morning, Ben. So CoinDesk Research recently issued a report in which they found that in 2021, Bitcoin dominance declined. And, we've seen an explosion in the alt market, it's particularly with specific alts. So just two things. One, going forward, 2022, do you see that alts are going to sort of decouple from Bitcoin in terms of performance? Because at least over the short term, like the past couple of days, the charts are just a sea of red, right? Bitcoin goes down, everything goes down. Do you think that will continue over 2022, or do you see more of a decoupling?
No, I definitely see more of a decoupling. And I can tell you, again, it's interesting, our perspective, because we speak only to other institutional investors. Back in 2020, it was, 2019, 2020, it was really all about Bitcoin. Bitcoin was synonymous with crypto. All of a sudden in 2021, we started to see investors discerning more between, Bitcoin and Ethereum. They understood that there were different value drivers. Ethereum was kind of underpinning, the DeFi, boom. And so, there was a greater discrimination among investors in looking at, all right, it's not just, do I want exposure to digital assets? Do I want Bitcoin or Ethereum or both? Now we're seeing the same thing with DeFi. What's interesting is a lot of the institutional investors I talked to that were originally very skeptical of Bitcoin couldn't really understand the value prop. It doesn't do anything, quote unquote. There were still even people saying it's a Ponzi scheme. Ironically, many of them understood the value prop of DeFi a lot quicker when we started explaining, that something like a Uniswap is really just a decentralized version of a Coinbase, for example. And instead of owning shares and stock in Coinbase, you can own the governance token of Uniswap. And so, consistent with your point about the decoupling, I think that's emblematic in what we're seeing in conversations with clients. To your point, right now it's a sea of red. This is just all risk assets selling off. But I think we'll start to see, not only decreasing Bitcoin dominance going forward, but, kind of continued rise of the alts as, they focus on kind of different value propositions and investors start to appreciate that.
Okay. Thank you, Ben. That was Ben McMillan, CEO of IDX Digital Assets. Coming up, can NFTs fight climate change? And Nick Day with today's regulatory news.
Hey, I'm Isaiah Jackson, host of Community Crypto and author of Bitcoin in Black America. You're watching CoinDesk TV.
The CoinDesk Spotlight is brought to you by Nexo, the place to earn on Bitcoin, Ethereum, and more.
NFTs have captured the world's attention with millions of dollars they have generated for digital artists. They've also captured the imagination of a climate scientist who is now successfully using NFTs to raise funds for his cause, fighting climate change. Joining us now to discuss his project is the founder and executive director of the Open Earth Foundation, research scientist Martin Wainstein. Hey there, Martin.
Hi, Michael. What a pleasure to join you today.
And you're joining us from Austria, I see. It looks like you've got that sort of ski resorty look behind you. So thanks for sort of finding a place to actually speak to us out there. Look,
Yeah,
Martin, I was there when you were. Go on, yes.
I was going to say one of the main things why we try to get the most out of this time of the year is that climate change is making sports extinct, and I don't think our grandkids will be able to enjoy the same ski resorts. So that's one of the reasons why we get the most out of it, but try to do the fights to make it as long as possible.
Yes, I mean, I know how much that's an important cause that you're focused on it. It's a sad reality, indeed. Look, I was there when you would sort of launched this NFT back in, I think, last year, beginning of the year-ish, the Oceanfront. It was a Beeple that sold for, I think you were pretty surprised by the number as well, $6 million that you raised for the Open Earth Foundation as a result of that sale. To me, that seemed to catalyze the real prospect that NFTs could be involved in some way in this whole, for good aspect of crypto. Can you talk a little bit more about where you see that intersection happening? What is the value proposition for NFTs and people who really want to get involved in conservation issues like those that you're involved in?
Well, one of the things that really inspired us is the ability for artists and creators to almost be a new face for philanthropy and for high impact projects. The story that led to the carbon drop, where Beeple's piece was sold for $6 million, was, as you know, back when we met, I was running a lab at Yale and working at MIT. And we went deep into how blockchain can help better accounting and accountability under the Paris Agreement. And not just blockchain, but IoT and AI working together. For the most part, climate philanthropies have a really hard time understanding emerging technology. And so in grants and different projects that we were trying to get capital to build open digital infrastructure, they had a hard time. And even in some meetings that I've had with high-flying philanthropies, they said, what you're trying to do is too complicated, it's too risky, we don't really understand it, it's too innovative. And when we had a chat with a group of artists in the middle where NFTs were starting to really pop in a good way, they said, this is great, we're all for supporting this. And then we basically had 2 artists, and then people joined, and then more and more started joining. We actually kept throughout the year having to tell the artists that we were at capacity. So I think what we found is as long as people still appreciate art and creations, artists have the capacity to decide what their creation supports. And we've seen that throughout last year, not just in the work that we've done as an innovative way of raising capital for a climate charity and research organization, but we've seen it in a lot of other artists taking that initiative. So we found ourselves into an extremely generous and supportive community. And I see a lot more of that coming through. Even at the end of last year, we did the Ocean Drop. And one of the platforms that we interacted with was called Doing Good. And that's a platform that specifically is trying to empower artists and creators to support and decide which social impact project they want to contribute. That's something we haven't seen before. So I'm pretty excited about that prospect.
So, Martin, your own website actually acknowledges a little bit of a tension here, which is that you're working obviously towards awareness of environmental problems, but you also, this NFT used Ethereum, which is a proof of work blockchain, which has a negative environmental impact, and you kind of acknowledge that. And so, let's just unpack that a little bit. So, what is the plan sort of going forward, right? Because we know that proof of work is not necessarily good for the environment. Would you, if you did this again, would you use a non-proof of work blockchain? What are some of the lessons learned from this?
Yeah, this was and actually, I really want to also credit artists in the NFT space to bringing so much attention around the carbon intensity of our blockchains. At the beginning of last year, the conversation around carbon impact of proof of work, both at Ethereum and Bitcoin, was serious. We were hearing this a lot, and we still do now. But that was not the case 3 years ago, and the issue was equally important. And I think we saw that artists were particularly sensitive about it. So in the lead up to the carbon drop, which we did in Nifty Gateway, which uses Ethereum layer 1, that was a major point of concern. Now, we believe in the technology, but we do specify and make extremely transparent to say at the current rate, the way proof of work works is not sustainable for the environment unless we do a massive shift. So to deal with that in the first drop, we in some way innovated creating an NFT of a carbon offset and pegged it to the NFT of the art to be able to, offsets don't necessarily allow you the permission to keep emitting, but it does bring a lot of consciousness and it does support financially projects that have a positive impact on the environment. So the lessons learned out of that, and we sent it also as well to different platforms, is urge them to move to proof of stake platforms, to communicate the impact to their users so people are more aware of that. But then the ocean drop, which was the second iteration of this, we particularly searched for entities that were using layer 2, particularly Polygon. And I mentioned Doing Good recently. They moved directly into Polygon. There are pros and cons. People are very used to Ethereum layer 1. We also collaborated with Super Rare. They are in layer 1. So the drop in Super Rare we did had a particular impact. We did carbon offsets again. So where do I see this in the future? Well, Ethereum already has the vision to transition out of proof of work. Bitcoins are really a harder discussion to go into. I see a lot more consciousness around the environmental impact of blockchain. I see the NFT space and the creators to continue being an active voice towards that, an activist in some sense. And I also think we're going to see a lot more carbon neutral, renewable powered mining. But that doesn't really solve the problem at heart. So in the general sense, I'm pretty glad that the NFT art space has broadened this discussion front and center.
You know, Martin, that discussion kind of reminds me of what's going on in the physical world, and that is you have many countries that are, if you will, a proof of work situation because they're trying to grow their way out of poverty. They're trying to grow their GDP per capita, and that's of course leading to a lot of carbon emissions to do so. So, how is your project? What your project is doing? How is that? How do you get adoption in those situations in terms of tracking carbon, et cetera, with places that are saying, look, we have people to feed in much the same way that Ethereum and all these other systems were proof of work. It's the same situation. There's no layer 2 for some of these economies. How do you deal with it?
Yeah, no, thank you for raising this because, of course, at the Open Earth Foundation, our mission and goal is not to do charitable auctions through NFT art, is to particularly work on mechanisms to help companies, subnational governments, and national governments keep in track to the Paris Agreement and find new ways of financing that. This is why accounting and preventing double counting is so important, and one of the why artists also believed in supporting something like that. So I think there's a mentality shift that's needed. When you mention countries that say, "Hey, I want to grow, but to grow, I need to use the energy sources that I have." Well, we now know that that's no longer the case. Renewable energies are one of the primary sources of jobs, so they're particularly relevant for economic boost, and they have just a lot more benefits. Furthermore, the primary issue here is most of these countries, and now we've seen, particularly last year, companies making pledges to stay in line with the Paris Agreement, which essentially takes us in a path to net zero emissions by 2050. So that's a radical shift over the next decades towards having almost no human-created emissions into the atmosphere. To do that, we have to chart the pathways and how those pathways are going to create new opportunities in the agriculture sector, in the real estate sector, in the infrastructure sector, and creating a lot more jobs, as I mentioned before. So there's a mentality and there's showing the way. There are countries and companies that have taken that. It's important to be able to track that they are in line because the last thing we want is greenwashing where someone says they're going to do something, but at the end of the day, there's just a minor effort that's just to cover a big scar with a small Band-Aid. But on the proof of work space, that mentality is relevant, but it's not as relevant as really going into redesign the protocols and get the community to tack in some sense. So I think there's the process that Ethereum is going to go through is fascinating. We're going to see a lot more of that.
Okay, thank you, Martin. That was Martin Wainstein of the Open Earth Foundation. Time now to check in with Nick Day, Managing Editor of Global Policy and Regulation. Good morning, Nick.
Hey, good morning.
Hey, so interesting story from this morning on CoinDesk about India. Wondering whether you can talk about what's going on there. This was tax authorities sort of seemingly surreptitiously auditing crypto companies. And of course, India has been a country that's been, let's say, somewhat hostile towards crypto and seen as a bit of a bellwether in where things are going outside of the US in terms of regulatory pushback against crypto.
Yeah, so the story you're referring to by our colleague Amitoj Singh, basically last year, India collected around $11 million worth of Indian rupees in back taxes, fees, and penalties from 5 different crypto exchanges. And this appears to have been a months-long investigation into whether or not these crypto exchanges were properly reporting their taxes and paying goods and services tax. And the tax authorities came to the conclusion that they were not. But the exchanges say that it's not a deliberate oversight. It's that the tax regime was unclear to them, and so they didn't realize that they had to pay the taxes until the authorities came knocking. And what really kind of struck me is Amitoj reported that a lot of these exchanges paid some fees on top of the taxes voluntarily as part of an effort to try and maybe head off more severe penalties further down the line. So clearly India's official agencies, if not the central government, are looking at this issue, and the taxman is always going to try and get their I didn't want to say lump of coal, but they're always going to try and make sure that taxes are paid. So
pound of flesh.
Yeah, pound of flesh. Yeah. So even if the much anticipated crypto bill out of the Parliament isn't coming soon, for sure it's clear that there are other entities looking at this issue.
Fine, I'll take the bait. Is this something that's going to something that we can look at in the United States with some of the proposals going on right now and say, okay, this might be how it plays out, or is this just a very uniquely Indian situation?
I mean, the IRS has been pretty active collecting taxes from crypto exchanges or crypto exchange users for years now. It's almost become a common occurrence where every year we talk about how the IRS sends out letters to crypto exchange traders saying, hey, we think that you owe taxes on XYZ transactions that you conducted in, 2 years ago. And, please talk to us or we're going to, come out at you. So, going back to my earlier point about, the tax collector always making sure they're on top of this, the IRS will make sure that it's collecting, whatever it feels is owed, even though, one of the issues, and this is probably a similarity between here and India, is a lot of people just aren't really sure how to file taxes on some of the stuff they're looking at. So, for example, in India, the article from this morning, it was a GST tax. Goods and services, this is a relatively new regime that India implemented in 2017 to try and consolidate some of its previous tax regimes. So it is actually a relatively new framework that exchanges have to abide by. Here in the US, a lot of users have, we've had long-standing questions about how exactly do you approach taxes, how, what transactions do you have to pay taxes on? The answer is all of them. But, now people are trying to sell, during a dip to try and offset capital gains from previous sales. They're trying to figure out, how to handle NFT taxes, because one of the, kind of not crazy, but one of the kind of oddities of the U.S. tax regime is every transaction is taxable. So, if you're just flipping NFTs, then every single one of those NFT flips is going to be a taxable event. And so, we're starting to see people ask questions about, okay, well, what's the best way to try and, report all of this in a way that is both comprehensive, but also not, insanely detailed and requiring you to go over hundreds of transactions.
Alrighty, thank you, Nick, for that. Dive into the arcana of US and also Indian tax law. That was Nick Day, Managing Editor of Global Policy and Regulation. Don't forget to sign up for Nick's State of Crypto newsletter on CoinDesk.com. That's it for First Mover. Thank you to my co-hosts, Lawrence Lewitton, Managing Editor of Global Capital Markets, and Emily Parker, Managing Director of International Content. It has been a pleasure working with you this week. Christine Lee will be back next week. She returns Monday, 9 a.m. Eastern, so you can look forward to that. Meantime, you can catch The Hash at noon, followed by All About Bitcoin at 3. You're watching CoinDesk TV. Stay tuned for the daily forecast with Mega Chata to see what's happening in Asian crypto markets.
Welcome to the Daily Forecast, January 7th, 2022. I'm Megha Chadha of Forecast News, covering all things blockchain. It's been a bumpy first week of trading for the year, but where are things headed now? We'll take a look at the market action and a whole lot more coming up. Let's get you up to speed from Asia to the world. Let's kick off with some of the top stories out of Asia today. First up, Korea is going full steam ahead with the metaverse with big announcements from both Hyundai and Samsung. At the CES 2022 event, automaker Hyundai said it has partnered with 3D content platform Unity to build a metaverse factory. The Meta Factory concept will build a digital twin of Hyundai's Motor Global Innovation Center in Singapore, supported by a metaverse platform, allowing staff to solve problems without having to physically visit. And customers will be able to test drive cars virtually before trying them out on the road for real. Meanwhile, Korean electronics giant Samsung has opened a new metaverse destination named Samsung A37X. Modeled on its New York City location, which it calls an experience rather than an old-fashioned store, users can enter the virtual world of Samsung A37X via Decentraland. Users can buy and sell digital assets, including land and wearables, as well as learning more about climate change action in the sustainability forest. Over in the crypto markets, the sea of red continued Friday morning Asia time after Thursday's flash crash, with Bitcoin losing just over 2.5% in 24 hours, falling below the $42,000 mark. Forecast News' Carolyn Wright has more.
Ethereum, Solana and Terra were the hardest hit among the top 10 by market cap, each dropping around 6% in the 24 hours to Friday morning Asia time. But one expert told Forecast News, while sentiment remains bearish for the moment, it's worth taking a step back from the short term.
For the year 2021, we saw unprecedented growth for the entire market, and even though price went up and came down, one thing that was on a single trajectory up, that is the adoption rate. We are seeing just active wallet numbers almost on a straight line up.
Ernst says that while it's difficult to identify exactly where the bottom is, the market will eventually bounce back. And though this week's dip was closely aligned with the broader market, he doesn't see that continuing due to the yield crypto has to offer. He also sees greater divergence ahead within the crypto market as it matures.
We are actually expecting to see, especially in the next 12 months, for the crypto market, intra-crypto market, to become less correlated overall, because now we see kind of when Bitcoin sneezes, every other cryptocurrency catches cold.
Ernst says there's already a divergence between the investor profiles for the two largest market cap cryptocurrencies, Bitcoin and Ethereum, with investors becoming more sophisticated as more and more enter the space. For Forecast News, I'm Carolyn Wright.
Will 2022 be the year we see legacy coins and infrastructure take a back seat as interoperability gets a greater push? Adrian Brink of Anoma, a protocol that enables trading of any kind of digital assets among any number of parties with full zero-knowledge privacy, joins me now to discuss how disintermediation could change the face of digital assets as we know them. Great to have you with us, Adrian. Wish you a very happy new year.
Same here, and glad to be here.
Adrian, the digital asset infrastructure in place at the moment is fairly siloed. For example, if one trades an NFT, it's largely on Ethereum. What limitations do you see of the existing system?
The limitations are twofold. For one, assets are locked into their specific systems, meaning that you have to reissue the same asset over and over again, because you can't easily move an asset from Ethereum to NEAR, for example. This is going to change in 2022. Interoperability is coming and it's here to stay. The second big problem, though, is that you're locked into the fundamental capabilities of what you can do within specific state machines. For example, you're locked into what exactly can happen on an exchange like OpenSea, which there's a funny anecdote. My co-founder Chris actually built the underlying backend, the underlying set of smart contracts that facilitates all of the trading behind OpenSea. And in 2022, we'll also see that users can take their assets that were issued maybe on Ethereum to platforms that give them completely new capabilities, thereby growing what users can do within the blockchain space and the industry as a whole, because all of a sudden, we can start seeing hundreds of different chains provide different kinds of capabilities to end users.
Now, 2022 is being looked at as the year that could dramatically change crypto systems. Do you expect a big push towards interoperability between blockchains?
Absolutely. And I think here it's important to understand that interoperability comes, currently there exists some sort of interoperability, but it's mostly a centralized, like 5 out of 6 multi-sig style bridging. Like an exchange like Kraken is also an interoperability system, right? Because it allows you to move from one asset into another and to deposit an asset on Ethereum and to withdraw an asset on Bitcoin. But these are all fundamentally trusted bridges. In 2022, though, we're going to start seeing truly trustless interoperability, where you don't have to trust any third party, where protocols directly and natively talk to each other. And this is probably going to happen via protocols such as IBC, that you can see a direct connection without any middleman from, let's say, NEAR to Polkadot, and from Anoma to Cosmos, and from Anoma to NEAR, and from Cosmos to Polkadot. And all of these, they're not going to be bridges, they're just going to be connections, because bridges implies that someone runs some fairly centralized infrastructure to do this connection. But in 2022, we're just going to see that an asset can move from NEAR to Anoma to Polkadot to Cosmos and back.
Well, 2022 promises to be a year of big changes, certainly. Adrian, thanks so much for joining us today. And that's the Daily Forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Megha Chadha. Until next time.